casually. We're both actually at home, not in the office. And I think we're up to about 46 people. Is it live yet? I don't even know if it's live yet. Okay, we are. Yeah, so we're up to 51. So guys, whoever's listening, the audience, welcome tonight to Endowus live webinar. We've been having a lot of official events, and our virtual conference was an amazing success. And thank you so much for everybody watching that and joining us. So tonight, Greg and I are just going to be talking casually about what's been going on in markets and, you know, our take on it and what Endowus really believes in and thinks about. So thank you for joining us. We'll try to keep it a bit casual today. So I will track the YouTube chat channel. Greg is going to be checking the Slido channel. So please look at the link underneath for the Slido. You can put your questions on the Slido, and yeah, and then we'll see how it goes. So let's make it as interactive as possible. Please join us and keep typing away in the chat and the Slido questions so that we can really touch upon the things that are most pertinent and most interest to you. Greg, anything to say to kick off?
No, let's get started.
All right. So yeah, I'll take these two, and then shall I take these two, and then you can take the main presentation?
Sure, go ahead, Sam.
So two promotions. One was on the Endowus Cash Smart product. So we have a tie-up with Lion Global, and if you sign up for an Endowus Cash Smart product and open up an account, and this is for new customers who do not currently have an investment account with us, you get $100 worth of units free when you open a Cash Smart account. And then we also, obviously, as we enter the Chinese New Year period, have a special promotion. We've actually lowered our minimum to $888. Most people remember our minimum being $10,000. And at the same time, we increased our referral bonus as an AMPO special. Red packet of $28 for you, and also the person who will be joining the Endowus platform. Right, Greg? It's for both people, right?
Yep, that's right. So, you know, it's a giveaway for Chinese New Year. You know, get started on your wealth journey, lowering our minimum to 888, and hopefully you can tell your friends and family about Endowus and what we stand for.
Over the holidays and many dinners and low haze and everything. It's kind of annoying that we can't speak and shout when we do the low hay. I've done two already, and it's so boring. You can't really make any noise. Okay, so those are the promotions, guys. So please spread the word. Also, a quick shout out to our Endowus Insights virtual conference that was held a couple of weeks ago. Amazing list of speakers, many CEOs from fund management companies. We also had Boon Chai, the CEO of SGX, and Chin Hang, the deputy CEO of the CPF board, Joe Cherian, our friend Lu Cheng Chuan, and Tim from Dollars and Cents, Ken from Seedly, Riming from The Woke Salaryman, and many esteemed speakers. And these are all available on the Endowus YouTube channel. So we have a bunch of content, so please click and subscribe below. We have amazing amounts of content that you can use to educate yourself, focus on the things that most interest you, and yeah, reach out to us if there's any content that you would like us to cover. Quick disclaimer, please take a look. We are licensed by the MAS, so we were required to provide this. And I'll hand over to Greg.
Yeah, so really quickly, for those of you joining us for the first time, our mission is simple. You know, we are a fee-only investment advisor. We help people invest better so that they can live easier today and be better prepared for tomorrow and retirement. Next slide, please, Sam. Yeah. in our experience, and this is something we personally struggled with, trying to invest and grow wealth in Asia is very difficult for three key reasons: a lack of aligned advice, where the person selling me the products are incentivized by a lot of the product providers instead of by me, the client; a lack of access to good products; and very, very high cost. This has led to poor outcomes and sort of been a call to action for Endowus to come into existence and to try and solve this problem. Next slide. So in our view, what we achieve is create a new wealth experience for the new age, one that is digital, hyper-personal, and holistic. So holistically across your CPF, SRS, and cash, with access to better financial products. For those of you who are clients, you know that Endowus has exclusive access to many institutional quality products across CPF, SRS, and cash investing, all at a lower cost. This will achieve better outcomes for all of your wealth needs. Again, we focus on advice, access, and cost. We've also, so no sales fees, no transaction fees. We've innovated the 100% trailer fee rebate. So any rebates we do get from fund managers, we pass back onto you entirely. We pick funds that are currency and tax efficient for Singapore-based investors. That means Singapore dollar hedged fixed income funds, Singapore dollar denominated equity funds, UCITS funds, which are tax efficient from a dividend withholding tax perspective and an estate tax perspective, unlike US listed ETFs. Rather than recreating product, we work with fund managers to access their products. Here are just a few names that we work with very closely, funds that you can access through the Endowus platform. Sam, you're on mute.
Whoa, sorry. I don't know what's going on. So just a quick explanation of what's been happening. I wrote an article on the weekend. So Greg and I take turns writing a column in the Business Times called The Science of Wealth. And last week was on this specific topic of meme stocks. So GameStop obviously being the primary name that everybody focused on, and other stocks like AMC and others, and they all move kind of similarly, but nothing like GameStop. So the R on the chart is the right-hand side scale. We've scaled it to 1,000%. So that's a 10x increase. So a company like Naked Brands went up almost 10x. But the two companies, Cost and GameStop, is indexed to the left. So cost went up to that 2,000, more than 3,000%. So 30x. But GameStop went as high as 90x. So it was an amazing run, and now this was as of when we published the article, but it's obviously fallen more. Came down below 100, down to below 50, and then it's bounced back a little bit. So it's been a roller coaster ride, and now stonk is a word that is very commonly used now, and everybody understands it. We all found out what it was in just a few weeks ago, and so it's really been captured the imagination of people, and a lot of it was also because I think it was because it was this fight against Wall Street, the David and Goliath kind of narrative. It captured the imagination of people, and how Main Street can sometimes overturn the experts, the pros at their own game. And I think, Greg, you wanted to maybe cover the short covering that happened with the hedge funds.
Yeah, so for those of you who have been reading the news, there was a lot of short interest in GameStop for the last 6 to 12 months. In fact, at one point there was more short interest than total stock outstanding. So For example, imagine that a company has 1 million shares. There was more than 1 million shares shorted of this stock. This is not good. I mean, this technically should not even be possible if you think about it, right? So how can you short more stock than what exists in the market? I think this kind of sparked the beginning of that Reddit discussion to say, hey, if we drive up the cost, or if we drive up the price of GameStop, the hedge funds or their brokers who are short the position will have to buy it back, to the point where the broker will say, you've lost too much money, because when you're short a stock, you can lose an infinite amount of money, right? So if you're long a stock and you invest $100, the maximum you can lose is $100. If you're short a stock and it's $100 and it goes to $1,000, you've lost $900. So you may have put $100 at risk, but now you've lost $900. So what happens in a short squeeze is when the price starts to go up. Sorry, up is this way in the viewer here, in the viewfinder here. And when the stock starts to go up, the hedge funds get pressured to cover the stock, which means that they now need to go to the market and buy it to relieve themselves of that short interest. Because there was so much short interest, when they went to buy it on the market and they just had to buy it at any price to cover the short, that causes the stock to go parabolic and skyrocket even more. So if you guys were tracking the day by day of GameStop, you would have seen, on the days where the hedge funds had to unwind their shorts, they actually lost. The stock actually went up even more and more as they were trying to cover those short positions. Yeah. So let me see if there are any questions about that.
Actually, it's been funny because the Reddit Army and the Wall Street Bets channels, they had another channel called Bursa Bets for the Malaysian market. And they tried it out on Top Glove, which is a stock that did well during the COVID crisis because of the, rubber and, doctors and hospitals have to use the surgical gloves and stuff. And so, it did well. And so they pushed it hard, and then, within days it came back. So I think the problem with these meme stocks oftentimes is that they're deep value stocks. They're stocks that, don't deserve to be where they are. And so fundamentals do not sometimes justify the performance. And that's why when it's inflated to this degree, artificially inflated, but the fundamentals do not back it up, then it's just likely to come back down. Obviously, Top Glove is an excellent company, and so it's different. But the next one they tried was silver, and so they've had some success, obviously, but also it came down quite sharply after the initial run up. And so these things are things that people ask, is it the right thing to do or the wrong thing to do? I don't think we can judge whether it's right or wrong. Only time will tell whether there are fundamental reasons for these assets to rise or fall. But the bottom line here is that when it's artificially inflated without any kind of fundamentals or stories to back it up, then the risk of you losing money, especially if you bought silver at $6,000, or if you bought Top Glove at above $7, or if you bought, GameStop at $600 or $550, then, when it falls to 50, you lose 90% of the value, then you're effectively screwed. Pardon my French, but that's how it happens. And so I think there's an underlying cause behind this. There's a lot of social discontent and mistrust is brewing. It's related to the social inequality, income inequality that's expanding. And, this perception that, individuals lack the tools or, capabilities, and it's frustrating. I think the COVID crisis was a confluence of events where people were stuck in their homes. Robinhood and these, free trading apps, supposedly free because there is a cost to it. And also the liquidity, the free government checks, for example, that came through that people were using to just bet on the market and stuff like that. I think that's been, some of the reasons why these things have happened. Obviously, I think it's caveat emptor. It's buyer beware. The buyer has to, and it's your money. So if you're okay gambling and playing around and losing all of it, and you're okay with it, then that's fine. But if you're trying to build wealth, this is not going to be the way to do it. During all this like mania and hoopla and noise and commotion, what did the S&P 500, the top 500 companies around the world do? They announced fantastic results. So this was the Q4 results, but this first quarter results, we're more than halfway through it, and the numbers are quite good. And what people forget is that oftentimes the things that go up the most, we have to remember, are the things that come down the most. So this was the intra-year fall in March 2020 to April 2020. And the same two asset classes that always higher volatility, Tesla and Bitcoin, actually fell the most. Tesla fell 61%, which is more than half, and Bitcoin likewise. So the worst, falls during March 2020 were the guys who have the higher volatility. And so risk and return, we always say, are perfectly correlated. The ones that give you the higher returns are going to be higher risk. It's going to be more risky. And so you have to be aware of that. Know what you're buying, invest in what you know. And, when you lose money, know why you're losing it as well. And one thing that people forget is that throughout last year, NASDAQ outperformed S&P 500 quite handsomely. And I know, especially in the 1M65 chat room, we always talk about S&P 500 and how it's done so well. But as financial advisors who are licensed, we have to advise you that, having a concentrated investment in one single index in one single country is risky because it can underperform other markets. In fact, S&P 500 has not only underperformed NASDAQ quite meaningfully last year. Throughout the year, NASDAQ returned 48% versus just under 18% for S&P 500, but every single year in the last decade. So NASDAQ outperformed every single year except 2016 when there was a bit of a wobble in the markets because of the taper tantrums and etc. But even in 2018 when markets fell, S&P 500 fell 4.4%, but the NASDAQ was largely flat. So out of 11 years, 10 years, NASDAQ outperformed, and people don't really realize this. And that's, the benefit of having a broad, diversified global market exposure is that you're exposing yourself to the right kind of companies. And the companies that do well can continue to do well, especially when the cycle extends itself. So there was a big correction, but this is a top 10 market cap companies and their performance in the last 12 months. And you didn't need to own the fancy GameStop and make those returns in a day or a week. If you just held these best companies that we all know well, these are companies that we know well. And in the Endowus broad, globally diversified portfolios, all of these names are in there. We own all of them. We have, if you invested $10,000, we have, a few tens of dollars to hundreds of dollars in these great companies, and they continue to perform well. And why bother with all of that if you can, invest in some funds that can, perform really well. So this is the most celebrated ARK Innovation ETF, and you can see the share prices. It's like a Bitcoin chart, isn't it? Like $30, $40 all the way up to 150. We are onboarding the ARK Innovation Unit Trust Fund, which is wrapped by Nikko Asset Management, and that'll be on our FundSmart platform very soon. So keep a lookout for that. But to Greg's point earlier about the short positions, look at that, ETF short positions. ETF is a stock, it's a listed entity, is listed securities. And so you can actually short it. And, we saw a big spike in shorts in ARK Innovation ETF even. So a lot of liquidity flushing around and people buying and selling. And money flows to the winners, 2 billion assets throughout 2018, 19, 20, and then suddenly it's blown up to 55 billion.
Hey, Sam.
Yeah.
Quick question. So, you've been in the industry for 25 years, and I can imagine that you've been through many cycles, and you probably have seen this type of phenomenon happen before.
Yeah.
Does anything? I mean, I'm sort of pulling a few questions together that I'm seeing.
Yeah. Other guys have been asking. Yeah.
Yeah. Can you remember anything that was as crazy as the meme stock phenomenon?
1994 was when I began. That was the run up to the 1997-8 Asian financial crisis. So across multiple assets, across multiple markets, across Asia, we saw a phenomenal performance. But even before I joined, though, there have been massive bubbles and performances that put this to shame almost. Japan had a massive bubble. Taiwan had a massive bubble. Korea during the 90s had a big bubble as well, in the 80s as well. So most markets that have kind of emerged in Asia had a massive bubble of some sort during their emerging period. The Asian financial crisis put the end to that. The 99 dot-com bubble, was equally, or if not worse, because I think the technologies that were being implemented and the companies that were being created really had nothing back then. I think a lot of the technology companies, even Tesla, you actually have tangible cars. Back in 99, we were talking about valuations based on eyeballs, people just clicking with no kind of revenues or e-commerce or, anything to back it up, any kind of revenue business model. And so just user counts were what was used to value companies, which was complete, BS really. But the more recent ones, 2007 was the big emerging market bubble, the global housing, bubble. We had the China A share stocks, which went through, I think it went up like 30x or something from the lows. So we've had many, many bubbles, and that's the problem, that human emotion is always chasing greed during good times, and then they're overly fearful in the bad times. Most recent one being March 2020. I think most people were overly fearful at the bottom and selling sometimes as well. And so these are all natural human tendencies of greed and fear, which drive action. But what's, I think, unique to this current cycle is the unprecedented nature of the liquidity. And I think there's been a lot of enablers. So I talked about, Robinhood and those apps, government checks, fiscal stimulus. Everyone knows about the quantitative easing and the monetary stimulus that is backing this up. But, when the quantum of money is so big and growing at such a fast pace, in a pace that, we've never experienced before, I think that the bubbles that we're seeing are appearing in multiple pockets, and they're happening in on a global scale. It's not just one or two markets that's driving it. It's across almost all asset classes and across the global markets. And one of them is Bitcoin. So, obviously the Elon Musk made headlines. He's been making headlines for the past, 6-9 months on Bitcoin every time he tweets something. But then he got his company to buy $1.5 billion worth of it. And it's questionable whether he actually bought a $1.5 billion worth of it, or it's now worth 1.5 billion, because apparently on Reddit again, it was in December, one of the, Tesla employees actually put it up on one of the Reddit channels that Tesla is bought like $390 million worth of Bitcoin at $3,000 range. So I think it was very recent. I think it was in the $3,000 range, $30,000 range. And so, actually, it might be 3,000, But anyway, whatever price it was, 30,000 or whatever it was, Bitcoin made massive headlines. The initial genesis was December 20 when Michael Saylor, who runs a fund that is he's the biggest proponent of Bitcoin, and they're the single largest owner of Bitcoin apparently as a fund. And they were debating, and Elon was asking, are such large transactions even possible? And so that was the genesis. But even Bitcoin, at least we can argue, has some use case, right? And it's actually a legit coin. I looked it up, Greg, and it is pronounced Dogecoin.
Okay.
Dodge,
Not dog ecoin.
not dog ecoin, which is what I thought.
It is a Shiba Inu coin.
Yes, no. So Shiba Inu, and it was a meme, and Dodge is a misspelling of dog. So it's like stonk. It's a meme, internet meme, right?
Okay,
That's the genesis.
Okay.
But the thing is that it was created for laughs. It was just for fun. It was a complete joke. It serves no purpose, and it's just a complete joke. It was just an internet meme, and they just put a Shiba dog face on it and issued it, and as a homage to Bitcoin. And now it's worth more than Western Union or Under Armour. So it's just gone nuts, and it jumps every time Elon or Snoop Dogg or somebody tweets about it. So it's apparently now the 10th largest cryptocurrency in terms of market cap, and Bitcoin is headed to $1 trillion. So yeah, I mean, FKFMS, I don't know your name, but somehow it feels like an orchestrated massive pump and dump. Ugh, yes, it is often how you feel, especially on something like this, because it serves no purpose. There's no like massive technology behind it, and it's just people joking around. So I see very close similarities to the Dogecoin, and pump and dump plays like GameStop and some of these guys where fundamentals are not backed up. I'm not sure I would place Bitcoin into that space. I think Bitcoin serves a purpose. As I said, it really buys into that anti-establishment sentiment of an anti-US dollar fiat currency kind of mentality. And it's the reason why gold and other stocks did well. So this is Elon Musk saying you're welcome to anybody who bought Dogecoin to thank them. But as I said, I think gold did really well for a while because people had the same rationale for buying gold, but it was just too boring, and it serves an actual purpose. So they had to move on to random things that have no true value and purpose, and they've been ramping it up ever since. But what's interesting is that actually the anti-US dollar trade is alive and well. So as most people know, Sing dollar has outperformed by double digits against the US dollar since the lows of March. And so clearly there is something much bigger going on, that, trust in the system and, traditional institutions is much, much lower. And the US dollar is not what it used to be. And some of it might be systematic. People will be talking up the renminbi and stuff, but otherwise, I think, it's very different. And this is a chart that I asked our investment team to create. Crazy things people, trade on and, rationalize and say that, hey, there's a correlation here. We need to look at charts. This is COVID death and the stock market. And people can argue that, hey, perfect correlation. But we know that there's absolutely zero causality. If you had to push it, then maybe this is the subsequent second order effect, which is that, death rise and, the economy has tanked. And so we've actually added liquidity to the markets, and that has led to asset inflation. So this, second order effect and argument is something that makes a little bit of sense, and clearly has been a big driver. And, as asset prices rise, and interest rates have reached a new nadir, I think inflation expectations have been rising from the lows quite a lot. Greg, any other questions before I move on to these
on this, I mean,
the macro stuff?
Yeah, I just want to highlight, prices. Prices are important, and there are a couple questions around, tech stocks, gaming stocks, and all that stuff. But I think Tesla is a fantastic example of how detached, the world can be, or the market can be, by just, there's no doubt that Tesla is a very innovative company run by one of the most sort of creative, ambitious people alive, right? Elon Musk. But its revenue is 31 billion and its market cap is over 800 billion. So at a company at that scale, it's being priced at over 20 times its revenue of 31 billion. What do you make of that? Right? I think I'm not saying the price is wrong, because that's how the market has priced it. But there could be serious multiple compression very quickly on stocks that are priced at very, very dangerous multiples that require a lot of growth for the company to reach those expectations.
Yeah, absolutely. I think we showed a valuation chart at the year-end review webinar at the beginning of the year, and valuations are quite stretched, whichever metric you use. Obviously, the argument for markets is that, hey, everything is different, liquidity is abundant, and there's very few assets, great companies to buy. We want to continue to have ownership in the the growth companies of the future, and they will eventually grow into their valuation. So that's a phrase that analysts and investors use quite a lot. I used to use it to justify a company that I owned. And at the time, that company, for example, was Tencent, right? Which traded at, 50 times earnings or 100 times earnings, or didn't have a profit like Amazon. But we had to justify it. And so we said the company is going to grow into the valuation. And many companies don't make it. So that's the reality, is that just like VC investing, where 99% of the companies actually fail, and only 1% companies survive from incorporation and initial investment. I think time will tell whether these companies justify their valuations. Amazon and Tencent are the exceptional rules. We cannot apply those kind of rules to every single tech company that has come out. You have to look at the addressable market. You have to look at the management and execution and competition, because that market could be shared. And Tesla, I think, will really depend on whether they do become the most dominant electronic vehicle manufacturer. And I think I saw just an article just before the webinar began, I think on Bloomberg or somewhere, saying that to own a Tesla Model 3 is so exorbitant here in Singapore, right? And yes, Singapore is a small market and taxes has not enough rebates, but it's true for a lot of markets around the world. So Tesla, how big can it be? How much market share can it take? The number of cars that people will be able to buy. All these fundamental reasons have to be justified over time. So yes, Jay Lee, high P price to sales ratios for growth companies are justified, and it's not justified. There's nothing wrong with it, and as I said, it could grow into it. But having said that, it's actually very rare for companies to grow into that type of multiple that fast.
Yeah.
So I think there will be volatility along the journey.
Yeah, should it be 23 times sales, or should it be 10 times sales? Because if the market decides that it should be 10 times sales, then if you own it at 23 times sales, you'll lose 50% of you'll lose 50% of your assets. And I'm not saying that being priced at 23 times sales is wrong. I just think that you need to diversify to have a real wealth strategy, because no single asset in the market is priced properly and then will therefore grow with human productivity. But the market as a whole, will average these things out and allow you to harvest returns. So I think that's just an important thing to note. I mean, we're not arguing about Tesla being a good or bad company or the pipeline they have. I just, you know, is the pricing fair compared to everything else? And I was just, when we were talking, I was just looking up the analyst, so the professional analyst estimates. And again, we don't believe in forecasting because basically no one has been able to do it to any degree of success. But the analyst estimates on Tesla stock, which is currently $850, range from 1,295 to $67. That's the range that the professional analysts are putting on Tesla right now.
So no one knows again.
Basically, no.
And
exactly. Yeah, that's right.
Yeah. And Jay, I stand corrected. I think the article was saying that the Singapore Tesla 3 costs more than twice what it costs in the US. But I think $116,000 is what it's going to cost in Singapore, which is, Singapore. So I think the article was highlighting how cars are expensive in Singapore, not really an article about Tesla. So I just looked that up while we were talking about it. But Kelvin had a question about an opinion between the joint venture between China and SWIFT and rumors of launching a digital RMB and its impact to traditional major currencies and even Bitcoin. I don't know, Greg, if you have any strong thoughts about that, but I think eventually it's not unfeasible for governments to issue digital coins of their fiat currency. But it's really the technology behind it. I mean, Bitcoin is an exceptionally well-crafted and designed technology with a limited and diminishing supply, which helps to increase the value or perceived value when there's more buyers than sellers, right? So it's a great I wouldn't call it a Ponzi scheme, but it's a great structure, pyramid structure, I don't know. And if you believe in it, and US dollar or any currency is not backed by gold or any physical assets anymore. So the definition of fiat currency is that it's not based on anything other than an IOU. It's the US government saying, I will pay $100 worth of value of whatever you buy with that piece of paper. And so I think Bitcoin is similarly something that will always be priced at whatever the demand and supply is for that Bitcoin. So when markets fall, Bitcoin will fall 50% because there'll be more sellers than buyers. And so I think the utility argument, I think, is weak. I think it's, as a store of value, it's only as good as what people place value on, and then it's just a greater fool theory. You sell it at a price to whoever wants to buy it at. So I think that's it. I mean, Bitcoin is not anything other than an inflationary asset, backed by some technology, and people can use it to buy a Tesla in the future, I guess, as a mode of exchange, as a currency. That's what it's supposed to do. But if it's widely accepted and everybody uses it, then the demand will increase. I don't want to spend too much more time on Bitcoin. I think, everybody talks about it so much, and if you own it, you're bullish. If you don't own it, either you don't believe in it and you'll never buy it, or if you, or you're really aching from FOMO and the pain of not owning it when your friends do. But it's like anything else. It's like Tesla. It's like any other stock that's done well. It's like GameStop when it was at 550 and went up, 100x. It looks good at the time, but what it will do in the future, no one knows. One key risk is inflation. It's not a major concern for us right now, but it's something to keep a watchful eye on. I don't think there's a lot of academic research about what inflation really is, because inflation is an arbitrary human index. And often a lot of it is outdated stuff like, mattresses or, cafe prices. I don't know what it's made up of in different countries. Pork prices in China. And housing and rental and also wages remains quite a big part of it. And as you know, there's been a massive divergence between asset owners and human capital income guys. So asset versus income, there's been a massive divergence. So asset prices done so well. So if you had a lot of money and you invested in markets and you've done well, but if you've been relying on income, it's been a struggle and it hasn't risen as much. And so that divergence is really wide. So there's a big debate whether asset inflation is inflation. And for all intents and purposes, it should be. It is a form of inflation because it pushes up prices and the cost of living everywhere. Housing, for example, is a primary case. Look at Singapore. Housing prices have bounced back and reaching new highs even amidst COVID. So I think these are things that you need to focus on. I think Fabian had a question about fixed income earlier and low interest rates. I think we saw a big outflow of treasuries for the first time since March 2020. And if you look at the long-term chart of where interest rates are and where treasury durations are and etc. I mean, it's priced for perfection, and so the economy will come back, but fixed income markets with low yield becomes a big problem. But if inflation comes back, I think there is a risk that the Fed will have a taper of their quantitative easing, which will maybe bring down risk a notch. And then interest rates also rising is something that we should be concerned about next year, just like 2018. And if they do, then the market may be a bit jittery. But if you're investing, then fixed income remains a very, very relevant asset class. And I think we need to change our mindset. I've mentioned this somewhere else before, but from fixed income being a yielding product, so when interest rates were 5% to 7%, then yeah, yield is great. And that's where I think people mostly used fixed income as a yielding product, as an income product. But fixed income now is generating returns as as a capital gain product. So when interest rates fall, it's the delta that leads to the increase in the price of bonds, and that is what generates the returns for your fixed income funds and the funds that are in Endowus. And so if you move from 1% to 0, and you move from 0 to -1%, and if you move from -1% to -2%, you are generating a positive return, and your fixed income returns will be quite decent. And so I think that even in a low interest rate environment or a zero interest rate environment or a negative interest rate environment, fixed income will still play its part. It will generate positive returns from capital gains more than yield. Secondly, it will be a diversifier because it's less volatile than equities in any kind of volatility like equities experiences like March of 2020. And so fixed income is still a very much relevant sector. And most people focus on the treasuries and government bonds where interest rates are super low, but corporate bonds, high yield, emerging market bonds, mortgage as well, mortgage-backed securities. And there are areas where we can, find mispricing and generate good yield as well as good returns. So fixed income remains very relevant to us. So I have some, these are the policy rates, but, have fallen, but it will continue to fall. And this was a slide from my year in review. I just wanted to recap that fiscal expansion and monetary easing coming together is quite rare. Even in 2008, we did not have the fiscal expansion portion of it. So it was really just QE, which eventually got tapered and then, ended. But the fiscal expansion was virtually minimal, if any. So it is very unique that the COVID crisis, which is, a very short, sharp pain, has resulted in a lasting, continuous flood of stimulus, both fiscal and monetary. And so that is a positive impact to markets long term. So let's pause just a little there for any other questions.
Yeah, Sam, there's some questions around a bubble.
Yeah,
Are we in the middle of a bubble forming?
feels like it, doesn't it? I mean, when there are bubbles in certain stocks and certain asset classes, I think, yeah, I think it is a bubble. Um, eh, a definition of a bubble, I mean, is very difficult. But I mean, we are seeing a widespread expansion of valuations and things that are unwarranted, like Dogecoins and GameStop as well is part of that. And I don't see it ending anytime soon. And bubbles normally end in a parabolic move before a bust. And the parabolic move is not quite there. So if you think about it, the past 3 years, we've had two major 20% plus corrections in the market. 2018, the markets were down 20% from peak to trough. That's a bear market. And bear markets happen only once every 5 to 10 years on average. And then 2019, we came back and made a new high. But then March 2020, we also had a 30% plus correction, which is the fifth largest correction in the history of mankind. So we've had two 20 plus corrections in the space of 3 years. So if you think about that, it's actually very, very rare. It's not that common that you have back-to-back bear markets in such a short period of time. And so if you look at it from the 2018 peak to now, the markets are not up as much as people think. So I think some portions of the market are good and have done fantastically well. Technology, I showed you the NASDAQ chart earlier, and we showed Tesla and Bitcoin and stuff like that, single asset classes that have done well. But broad market has not done well. And that's the difference, I think, in this cycle right now, is because of COVID and for various reasons. A lot of the bubbles are very concentrated. But a true bubble that really damages the economy and stock markets for a long period of time needs to be much, much more broad-based. And I really don't see it. I really don't see it at the moment. And all asset classes have done relatively well, but not one single asset class has reached exponential move followed by a risk of a bust. So yeah, I think maybe more of the same, and maybe from here to, I don't know how long is the exponential move. So get ready. If it's a roller coaster move, we can see things be much, much more stretched and pricey before it blows up. And as we saw with GameStop, 100x return in a few weeks. That's what I mean by exponential. And we might not see it for the overall market, but big parts of it could see that.
In this scenario, or even through a bubble, how should someone think about their wealth, or how should someone invest?
Yeah, I think what we're seeing is actually rotation. So when gold starts doing really well and everybody's bullish gold, that was the peak. And we heard of people like massively allocating to gold last year, and since then it's just really done nothing. While the markets have done phenomenally well, and the point was that everybody was bullish on gold, and we warned at the time that hey, it may not be as exciting as people think. And so, yeah, I mean, and then people rotate to Bitcoin, and people rotate to Dogecoin and GameStop and stuff. And so there will be rotation. And one interesting rotation that we must talk about is value, right? Because when deep value stocks, outperform, that's a trend that is worth noting, because value outperformed post the dot-com bubble bursting in '99 for over a decade. And that was really what made value what it was. But ever since the global financial crisis, for another 10 years, value has underperformed. And last year was the parabolic underperformance of value versus growth. And so this year, already towards the end of last year, coming into this year, value has started to outperform. And what that means is that when the market was, in shock with the COVID, people just bought Zoom stocks and stocks like Zoom and, technology and software and, companies like Tesla. But as the market and the economy normalizes, and, that's why I show the economic, recovery, which is very relevant, that if there's a broader recovery in the economy, then other sectors in the industry, in the market, like financials, for example, which has done tremendously well, and other industrials, and for example, oil has come back very strongly, even despite EV sales going through the roof. Oil prices back because people start to travel again. I heard from a friend, President's Day weekend is going to be like ridiculous because people are going to travel a lot, especially in Silicon Valley. So, things will change, and I think there will be rotation. I think value may have its day. You may even have a decade. We don't know that. Well, obviously, once again, we're not making forecasts, but what we do want to know, touch upon is, the truth, long-term truth, that hold true regardless where we are in the cycle, regardless of, which asset classes are doing well, and regardless of what rotation is happening and what factors are outperforming. This is a really interesting chart of JP Morgan doing a survey from 1988 to present, which was, late to 2020, of people who were investing on any given day versus investing at all-time highs. So investing a certain amount of money, on the day that the market hits an all-time high versus every other day. So investing on every other day, up or down. And as you can see, the 1 year, 3 year, 5 year, consistent returns, that if you invested at an all-time, actually it did better than any other day. What that means is that, markets have traded higher. And, I ask this question a lot. So I'm going to just do it again for those who are new. What happens to markets when they hit an all-time high? And most people think, oh yeah, it's going to fall again. But actually, no. The most probabilistically higher, outcome is that the market will make another new high. So after an all-time high, they make another new high because the market is trending up, and because the market over a long period of time is actually moving higher. And so we show this chart, which is, the period in history when the markets actually were in a bear market versus the periods in history when the market was making new highs in a bull market. And we know that the market is always trending, upward curve with a long-term return of 7 to 9%. And, the markets tend to go up for longer and more than people think. So, this recent bear market, we didn't put in the 2018, which is, this one here that fell. We could have started a new one here, I guess. And maybe we'll do two versions later on, but we had a 33% fall, and we would have had to create a new one anyway. So in a way, we're actually just beginning. And even if we assume that, this is a similar trajectory as the 90s bubble, 99 dot bubble, and this was the 44% dot-com bubble bursting, and we had a 34% bust, the market will be up another 100% plus before we see any kind of correction. And so, these are things that I think are relevant. And so we need to understand that. And so investing in an all-time, timing the market basically is a mug's game. And this is another chart that we've shown many times before, from 1970 to 2020, 50-year period. If you had invested just $1,000 and left it, it would have grown to 121x. Yes, so even better than GameStop. So 121x. But if you had missed one day, one best performing day, the return would have been 108. If you had missed 5 best days a week, then it would have been almost half. And if you missed a month, it goes down to as low as 26,000 days. So, being invested is really important, especially when cash is trash. And, we've had this debate before, but cash really is trash, gives you nothing. And that's why, we create something called Cash Smart so that you can get better yield. But you should remain invested in markets for the long term because of these reasons.
Yeah, Sam. Hey, I just want to add a few things.
Yeah, please.
Some questions about hyperinflation, interest rates rising, stuff like that. Yes, there is a lot of fiscal stimulus right now, a lot of printing of money through quantitative easing, taking on more debt. But I mean, what does shock me, and maybe Sam, you have thoughts on this because you've been in the markets for such a long time, but Japan has been running a huge deficit for so long, yet they seem incapable of bringing inflation back into their economy. So even if signs are very obvious, like we're printing all this money, there should be inflation. It doesn't always happen like, clockwork. In fact, it rarely happens like clockwork.
Yeah, absolutely.
And yeah, I think for that reason, it makes it even more difficult to try and time the market.
Yeah, it's so true. And I think the whole argument about inflation is flawed because, again, it's looking at consumer price index inflation, which, in Singapore, the average inflation rate has always been 0.6% to 2%, 1.6%. That cannot be true. We live here. I've been here 15 plus years, and Greg, you've been here long enough. And everybody knows that the cost of living has risen much, much more than 1.5% to 2.5% in Singapore by any measure. That's the floor of a CPI index. I think that it's really difficult to get inflation in a economy or a country where demographics is working against you. So I'm a big believer in demographics as a major force, because as an economy, really only two things really drive growth in a major way is, as a delta, is not just it's productivity and it's demographics. And so demographics is working against pretty much every single major economy, including China and many parts of the emerging market. And that's why, growth is hard to come by, and also inflation is hard to come by. So the only thing that's working in our favor is technology and productivity. And productivity gains, a lot of it is coming from, companies gaining productivity by paying people less. And that's what's causing the social, discontent, because I think that's the problem, that we're not, we think productivity is cutting people. We think productivity, is paying people less. But what it leads to is stagnant growth, and what it leads to is disinflation. So the only place where inflation is really occurring is asset prices, and the things that are of value, and that's car prices. It's watches, Rolexes, and stuff like that, I guess. In Japan, I think we may be moving into a Japan-like scenario where inflation is hard to come by, but interest rates are permanently low, and debt continues to pile up. And so I think that's another risk that people don't really think about right now, is that debt has climbed to a tremendous level. The consumers have net saved during COVID, so their balance sheets have improved a little bit, but that's just debt of individuals shifting over to the government. So government debt has really spiked up across the globe. And corporate debt has been low, but it's starting to rise a little bit. And so I think government debt is the place where I think a lot of people have concerns. And that's precisely why the trust in fiat currencies is weakening. The belief in treasuries as the safe asset class is also diminishing a little bit. Those are the areas that I think will also be really interesting to watch in the next decade.
Okay, cool. Thanks, Sam. I think we're out of time.
Yep.
Lots to think about. People should, if you have an investment plan, stay in your seat. I think that's very important. If your liability
Sorry. So before you go on, I did want to say that the biggest mistake people will make is holding on to too much cash. I think that is the single biggest problem right now, especially in Singapore, right? Where everybody still owns some kind of fixed deposit or owns too much cash. And then people are selling this, oh, rainy day funds, you have to have 6 to 12 months and not 3 months now. I really don't know why that's the case, especially since we just had the biggest crisis of our lifetime. And cash is yielding you nothing. So I really think that, and we've shown that, being invested is the right thing to do. And most people don't invest as much as they should. So I think, cash is probably the worst thing you can hold, because cash is going to be devalued over time. Sorry, Greg.
No, that makes sense. And I think, if you have an investment plan, you need to sort of set your asset allocation in line with when you need to use the money. And you can have different asset allocations or different goals mapped towards when you need to use that money. And
it's called the liabilities driven model, right?
Yeah, liabilities driven asset allocation model. And then once you set that, you really need to stay in your seat and respect markets as a whole. I mean, today we talked a lot about speculation. I think you can have a speculative bucket. I don't see anything wrong with that. But I just wouldn't rely on it for, money that you really need to plan for to improve your life or to maintain your lifestyle. And I think if you can keep those things separate, then yeah, you can participate in Dogecoin, you can participate in GameStop and all these other things, but treat it properly in your broader sort of, asset allocation framework. So, yeah.
Yeah, sounds good. And I'm just gonna end with the 2 slides again on the promotion, $100 for the Endowus Cash Smart account creation. Precisely because you shouldn't be holding cash, especially with your bank, which is going to give you nothing. And some people talk about these, bank deposit insurance. It's never actually been used. In a scenario where the Singapore banks have to use their Singapore deposit insurance scheme, is when Singapore goes bankrupt and DBS goes bankrupt. And so, I think you need to understand that actually, if you require a SDIC guarantee on that, amount, then you're probably not going to have a job. The world's probably going to be almost, in a disaster scenario. So, relatively safe Cash Smart Core, which gives you close to 1% yield. And then we have Cash Smart Enhanced and Ultra as well now, which gives you a little bit more oomph. And so you can also use our Fund Smart platform to create your own cash management account portfolios. And yeah, so we just wrap up with this slide, and just to wish all of our clients and YouTube subscribers and friends and family and loved ones a wonderful Chinese New Year. I'm gonna use my fluent Mandarin to say 新年快乐 and 恭喜发财. And since Greg's from Hong Kong and I used to live there, 康黑发财. And if you're Korean, 새해 복 많이 받으세요. So I'm gonna flex my language skills.
Great. Thanks, Sam. That was really fun. Thank you everyone for dialing in tonight. And we look forward to seeing you again soon.
Okay. Take care, everybody. Have a wonderful evening and Chinese New Year weekend.
Yeah. Bye-bye.
Enjoy your time with the family.